All right, I'll get started with my brief housekeeping remarks as people join the webinar. My name is Claire Ladd. I'm the Programs and Services Manager at the Mass Nonprofit Network, or MNN, and thank you so much for joining us today. Just a few quick items before we dig into the webinar. The recording and the slides from today's program will be emailed to you following the webinar, probably today or tomorrow, so please keep an eye on your email for that. If you have any technical difficulties during the webinar, you can reach out to me using the chat. And if you have any questions for the presenter, you can submit them via the chat or the Q&A function. I also want to give a little background about us here at MNN. Our goals are to strengthen the nonprofit sector through advocacy, public awareness, and capacity building. As part of our capacity building efforts, we offer regular webinars in partnership with our affiliate members. So please stay tuned for future topics in the new year and reach out to us if you have any topics you'd like to see. Our efforts are made possible by our more than 600 member organizations. Thank you to all of our members, and to anyone who is not a member, you can visit massnonprofitnet.org/join to find out more about all the benefits that membership has to offer. Okay, today's webinar is titled NICRA 101, Meaning and Methods Behind a Negotiated Indirect Cost Rate Agreement, and it's presented by Hatsy Cutshall of YPTC. So I'll now hand it over to Hatsy to get us started.
All right. Thank you, Claire, and thank you all for attending. I'm going to share my slides and hopefully show you what I mean to show. So, Claire, can you confirm that you're seeing the right
Yes.
view? Okay, very good. Thank you very much. So, welcome everyone to this program on, some people say NICRA, some people say NICRA 101, meaning and methods behind a negotiated indirect cost rate agreement. This is an overview that defines a NICRA, the importance of and methods for allocating shared costs, and what goes into an application for a negotiated rate. As Claire introduced me, I'm Hatsy Cutshall, and I'm currently the director and market leader for YPTC's New England team. In January, I will become the head of YPTC's new Government Awards Management Department. I've been with YPTC for more than 13 years, and I've had the privilege of leading teams in DC, Phoenix, and now New England. Prior to coming to YPTC, I was the CFO for two largely federally funded nonprofits, where I learned the rules that govern federal awards long before there was uniform guidance. Along the way, I've helped many organizations apply for and administer negotiated indirect cost rate agreements. I'm excited to have the opportunity to help clarify what can be a very confusing topic. This presentation includes a lot of information. I'll do my best to clarify as I go. If you have questions along the way, please put them in the chat or the Q&A, and I will pause to address them between sections of the program. If I do run long, you will all receive a copy of these slides as well as a NICRA cheat sheet, and I can stay on after 2 because this program will run right up to the hour. Here's a quick promotional moment about YPTC. We are a professional services firm that specializes in nonprofit financial management, and we've been doing that for more than 30 years. Our services include accounting, reporting, data visualization, and best practices, just to name a few. We have nearly 800 staff members helping close to 2,000 clients throughout the US, as well as some overseas. We've got some learning objectives today. As you might imagine, we will be defining a negotiated indirect cost rate agreement, which is abbreviated to a NICRA, since this is a federal topic. We'll look at some related guidance and terminology. We will talk about why or why not your organization might apply for a negotiated rate. We'll describe and illustrate common cost allocation methods, summarize the types of indirect cost rates, and outline some typical documentation requested when preparing a proposal. We're offering this program because many of you are working for organizations that either have a NICRA that needs to be renewed, or they may want or need to apply for a NICRA for the first time. And just as a note, in order to include indirect costs as part of a federal award budget, a nonprofit must either have a negotiated indirect cost rate agreement, a NICRA, or elect what is called the de minimis rate, which we'll talk more about in a bit. We've got an agenda to get us through to those learning objectives. We'll start with a basic discussion of cost allocations and why they're important. Then we'll review some NICRA basics, including definitions and FAQs. We'll look at the various allowable rate structures that you'll see when you apply. And finally, we'll talk about how to prepare a proposal. Before we can talk about NICRAs, we really need to talk about cost allocations, or how the math works. And why is that important? It's because a NICRA is essentially a detailed description of an organization's cost allocation plan. What are cost allocations? In simple terms, cost allocation is the process of spreading shared costs or expenses across activity centers, departments, programs, however you organize your financial data. For nonprofits, this means spreading costs by the functional categories of program, management, and general and fundraising, terms that should sound familiar if you've ever read audit reports or looked at a Form 990, where these breakouts are required. You may also need to allocate to one or more additional lower levels, which could be departments or programs or activity centers. You're not limited to just describing things in terms of those three categories. Costs can be termed as either direct or indirect. Direct costs are just what they sound like. They are directly and usually easily identifiable to a specific program or activity, while indirect costs are not. Indirect costs benefit more than one objective, program, activity, so forth, and they're not readily identified to just one or two. Indirect costs are also referred to quite often as facilities and administrative costs, management in general, or simply overhead. As examples, classroom supplies are usually direct costs for a Head Start center. Office supplies are usually indirect costs because they benefit all programs and activities of the organization. Nonprofit organizations should have a cost policy statement that outlines their cost allocation methodology, and we'll see an example of that later. Why should we allocate costs? Sounds like a lot of work. Cost allocations are required for financial reporting under GAAP, generally accepted accounting principles, and we'll mention that accounting guidance in more depth in a moment. The IRS also requires allocations on the Form 990, which is required by 501c3 and C4 organizations. So cost allocations are required to attribute shared costs to the correct functional categories on those reports. Some funders also require cost allocations. When you receive federal awards for the first time, nonprofits are often required to submit a proposal and negotiate an indirect cost rate agreement that equitably distributes the proportion of indirect costs to each program. This is known as a negotiated indirect cost rate agreement, the heart of our topic here. And this is why we're discussing this idea. But regardless of all those legislative or agency requirements, cost allocation is a good idea and really necessary to perform effective and useful business analysis. So we're now into topics related to our accounting information system. What is the best way to develop a cost allocation method? You need to develop a system that's rational and consistently applied. As you know, a nonprofit will report costs in one of two primary functions, program services as well as supporting activities. And supporting activities include management in general and fundraising, and membership development if your organization has members. Under generally accepted accounting principles, nonprofits are required to include a description of the methods used for allocating expenses in the notes to their audited financials. To support that disclosure, a nonprofit will need to document the method used and the basis for selecting that allocation method. The good news is that GAAP does not require a particular method of allocating expenses, just that they be rational and consistently applied. But that's exactly what makes this hard for many organizations, because there is no one right way. So let's illustrate with a step-by-step example. You might take this approach to first identify the costs to be allocated. Look through all your expense accounts in your general ledger and your chart of accounts. Your analysis, you should include every active expense account and determine whether it is direct, indirect, or some combination of the two. Then you want to categorize those costs, break them down as direct or indirect. And once you've narrowed down the indirect costs that should be allocated, you'll need to identify how they will be allocated by determining that basis for allocation. So it's important to choose an appropriate allocation base. And again, there's no one right way to do it. You might use the percentage of time and effort based on timesheets. You might look at full-time equivalents in some cases. Square footage is often used to allocate rent, utilities, anything related to the physical plant. Direct costs sometimes may need to be allocated, such as those classroom supplies for Head Start. A Head Start center might buy classroom supplies in bulk and then attribute those out to each classroom based on the number of students in the classroom. There may be other key performance indicators that make sense in the context of how your organization operates. Once you've decided how to allocate, then you need to develop the formula. A lot of this gets done in Excel. So for instance, as we mentioned, if you're using square footage, rent and utilities, if you've got a program that occupies 30% of the total office space, then 30% of rent and utility costs could be allocated to program A. I'm not saying that's the one right way to do it, but if it makes sense in the way, given the way your organization operates, then it's certainly fair to use. Then you need to implement your methods, apply the allocation formulas, ensure that all the staff working with the allocations understand the process and the importance of accurately tracking and reporting those costs. Keep in mind materiality, meaning if for insignificant amounts, it may not be necessary to go to extreme lengths. Don't spend so much time allocating pennies that you fail to meet your reporting deadlines. For most nonprofits, salaries and wages generally make up 50 to 70% of your total costs. So focus your attention on the big stuff, the salaries and wages, or whatever is your largest expense category. And then go back and review periodically, because what's working now may not make sense next year or 2 years down the road if you get a different mix of funding or take on a new program. As programs expand or contract, you may need to adjust the allocation bases and formulas. You also, as you build this, you want to make sure you're in compliance with funder requirements. If you're getting grants and other similar funding, ensure that your method complies with any specific requirements from funders. This is particularly important with federal grants. And then again, I'll reiterate, it's important to communicate your methodology to all the stakeholders, those that are doing the work, as well as your executive team and the board of directors. That transparency ensures buy-in and understanding across the organization. Some do's and don'ts of cost allocation. You want to be sure and document whatever you decide on. This provides an audit trail so that if you're not around in the future to explain why and how you came up with the methodology, someone else can pick up that information and figure it out themselves. And then use automation where possible. In smaller organizations, a lot of this will probably end up being done in Excel. And there are ways of automating a lot of what goes on in Excel, but you may also be using an accounting system that has allocation tools either built in or as an option you can add on. So you might want to look into that if you find this cumbersome. There are also time-saving allocation applications. What you don't want to do is to incorrectly classify management and general costs to direct costs. So HR, for instance, typically ends up entirely in indirect costs. Now, this might lead to a discussion of why your CEO may be charging some of his or her salary directly to grants if you are federally funded. That's a very common non-GAAP adjustment that many organizations make. In some cases, it reflects what's actually happening. And in some cases, it's a decision that helps keep their indirect cost rate down to what they consider a more politically acceptable rate. This is part of a conversation that we always have when we work with groups that are considering applying for a NICRA. You want to consider your audience and don't use groupings or categories that only make sense in your organization. And then you don't want to modify your allocation plan to fit a funder's budget. You want to make it consistent across all of your funding sources. Here's an example of cost allocations and how you might come up with the way things get attributed. So we've divided up salaries here up at the top. Salaries are split out across the different program areas of art, education, and empowerment. There's G&A as well as fundraising. And they've simply determined the proportion of total salaries in each of these areas, probably using using timesheets. And then down below, you see a list of costs like health insurance benefits, payroll expenses, and so forth. The to be allocated column in pale yellow, we apply the ratios up above to each of those totals, and then that tells us how much of the health and insurance benefits go to art, go to education, go to empowerment. There's a checking formula on the right in the gray column. It's this simple. It looks simple, but if Excel is not your favorite application, then you might want to talk to someone who's more comfortable in it. There are programs, as mentioned, such as Cost Allocation Pro that can help you automate these allocations. They can track allocations by account and even down to individual employee if you happen to need that in your reporting to your funders. So how do we set up our accounting system for better grants management? How do we make this easy? Let's start with the foundation. And by that, I mean a chart of accounts. And that means looking into the best ways of using your accounting software. Here's an illustration. When you set up your chart of accounts, don't create a new account every time you have a new program or funder. The ideal is shown over on the left. Look how concise that is. What you don't want to do is what you're seeing on the right with a separate revenue account for every different award that comes in. It will drive your accountants crazy. If you do that, it makes your chart of accounts really long and can make the reporting really tedious and cumbersome. Because we see so many organizations using QuickBooks, we've got an example in the next slides to illustrate this point. It was created in QuickBooks Online. However, you can create a similar presentation in other software packages by using the account segments and some strategic account numbering, and then rolling them into header accounts using whatever reporting tool is in your software. It's always a smart move to ask a skilled accountant to help you set up your chart of accounts. So let's take a look at how we might set things up in QuickBooks Online. First, you want to toggle on the Track Classes feature. In the error, I know this might be a little bit faint for some of you. You want to turn on that option to track classes. Create classes then for your functional activities, as is illustrated over on the right. We've got the fundraising, the general and administration and programs, but you can also have subclasses to break things down even more, if that's how you need to be reporting things. You don't want to create classes for funders. There's another way of tracking funders, or the names of grants. There's also this option. Some people choose the option to create a class called To Be Allocated. I find this redundant because if you run the P&L by class in QuickBooks, it comes up with a column called Unclassified that achieves the same thing. But if this works for you, it's certainly something we see quite often. Here's how you might keep track of your funders, your different program activities. From the expenditures menu, toggle on the track expenditures by customer setting. This will let you run a report showing revenue and related expenses by the funding source. If a funder provides funds for multiple projects, no problem. You can use classes as well to track the various projects or set up a project within QuickBooks Online. QuickBooks keeps adding more and more parameters. So what I'm getting at by utilizing these features, here's a sample profit and loss by funder. So if you need to send a report to, say, the USDA for their federal grant, over here almost to the right, you can run that report and filter there. For the sake of simplicity, I've only got a line for overhead and indirect expenses, but most likely these get reallocated or distributed within each specific account. Before I go forward, Claire, are there any questions in the chat?
I'm not seeing any questions, so keep going.
Okay, all right. Next, we will talk about some NICRA basics. Let's move on to our main topic, the NICRA. We're going to be using a lot of terminology as we work through this program and a lot of acronyms. This is the federal government we're talking about after all. We've also created a cheat sheet of terms to help you remember what we talked about in this program, and that will come to you along with the slides after the program. The Office of Management and Budget, or OMB, establishes the guidance that all other federal agencies must follow in order to manage grants and cooperative agreements made by the agencies. Uniform guidance represents the rules and requirements for federal awards established by OMB. Keep in mind that this is guidance, not regulation. The Code of Federal Regulations, or CFR, codifies and organizes federal agency regulations into one publication. Once each agency adopts the OMB's uniform guidance, sometimes providing their own interpretation of those rules, it becomes regulation. It's also always important to read your award documents for how the awarding agency is interpreting the guidance. So even if uniform guidance says a cost is unallowable, such as advertising or meals and entertainment, if a federal award budget is approved with those costs included, they become allowable costs, but only for that award. Here's an overview of the CFR. The easiest way to read the Code of Federal Regulations is online. And uniform guidance is housed in 2 CFR 200. I'm not going to read all these citations. You'll get the slides. You can follow up on them. This view is a quick but nowhere near comprehensive overview of the Code of Federal Regulations. It's a good idea to become familiar with all the subparts of uniform guidance. I recommend you start with subpart E, which is the cost principles, and that's where they discuss which types of costs are allowable or unallowable on most federal awards. This is way too much to take in one sitting. I tend to go back to certain sections periodically to see what may have changed. You'll need to pick away at this over time to absorb it. So what is a NICRA? We're going to start at the top. It is a document that's published by a federal agency that reflects an estimate of the indirect cost rate agreed to between the federal government and a grantee's organization. In layman's terms, it's a formal description of the organization's cost allocation plan and methods. The NICRA is built on the audited indirect costs and fringe benefit expenses incurred by the organization. In very large organizations that receive $10 million or more each year in federal funding, you'll determine separate rates for facilities and administrative costs. The rate approved in the rate agreement is a maximum that may be used during the period defined. How is the negotiation process started? With an indirect cost rate proposal. The proposal includes the documentation that an organization presents to support its claim for reimbursement of indirect costs. This application and the negotiation process assures federal funders that your organization has the capacity to manage its financial resources effectively and to attribute costs fairly and consistently, which is the name of the game. Note that these rules and processes apply to federal grants and cooperative agreements. For federal contracts, refer to the FAR, the Federal Acquisition Regulations. Those rules are similar in many ways to the uniform guidance, but they do have some significant differences that you should know if you manage both federal grants and contracts. In this presentation, we're referring primarily to uniform guidance. So why might you apply? There are good and bad reasons. A good reason is that your organization may know it wants to pursue more federal funding, and having that negotiated rate can make it easier to support the budgets in upcoming applications, and thus easier to get approved. A bad reason that I see quite often is that someone on the board of the organization thinks the organization should have a NICRA, whether or not they know what it means or not. Some federal and state funders do require a negotiated rate, as it then allows the agency to quickly determine the appropriate allocation of indirect costs. So it can increase an entity's chances of federal award approval, as well as streamlining the budget process. Another good reason for applying that I see with lots of clients I'm talking with recently, if your organization has used de minimis for quite some time, but has determined that it's costing the organization money since their true indirect rate runs higher, that's when it's a good idea to negotiate, because de minimis was never intended to fully cover indirect costs. Any non-federal entity, such as a nonprofit that does not have a current negotiated rate, may elect to charge what's called the de minimis rate, which was recently raised to 15% from 10%. It's based on modified total direct costs, or MTDC. The de minimis rate may be used indefinitely and no documentation is required. It works a lot like per diem. For awards made prior to 10/1 though, 10/1 of this year, it's worth asking if a budget modification can be made to take advantage of the higher de minimis rate. I've seen different agencies respond differently on this question, but it's always worth asking. The worst they can say is no. We'll talk more about de minimis and those recent changes later in the program. So I keep using this term, indirect cost rate. Just what is it? It's a ratio or division between total allowable indirect expenses and a direct cost base. It's usually a tool to determine what portion of indirect costs each program or cost center would bear. It's intended to provide a fair and equitable process. The feds don't want to be paying any more than their fair share of indirect costs. And many organizations develop indirect cost rates to help them manage the true costs of their programs, whether they're funded by the government or not. It's that important, a management tool. If you're an accountant, you studied cost accounting along the way and you learn the basics of attributing shared costs. That's what we're doing here. So how does one obtain a negotiated rate? You apply for and submit a proposal to the cognizant agency. And that agency is typically the one that awards the nonprofit its largest dollar amount of federal funds directly. If most of your federal money comes through as, if you're a subrecipient for most or all of your federal money, you may not be eligible to negotiate directly. We'll talk a little bit about that in a moment. The cognizant agency is the federal agency that's responsible for reviewing, negotiating, and approving cost allocation plans and indirect cost proposals on behalf of all other federal agencies. You may end up negotiating with an agency that does work on a contract basis for several other agencies. So for example, if you're getting money from EPA farms out their negotiated rate work to Department of Interior Business Center to negotiate rate agreements on its behalf. Once an agency is assigned cognizance for a particular nonprofit, that assignment will not change unless there's a shift in the dollar volume of the federal awards directly funded to the organization for at least 3 years. That said, I've seen a change made when there's only been a change over the course of 1 year. So the guidance reads 3 years, but I've seen some agencies that go from year to year and see a change in the mix of federal funding. I've seen them make a change in just that short time. The indirect cost rate proposal contains documentation that supports the entity's claim for reimbursing indirect costs. Once it's submitted, it can take 6 months or more to get approval. After the rate's been agreed upon, it must be accepted by all federal agencies. Now, I've known situations where one of my colleagues could not get a reply from the agency that provided the most direct funding. And in that case, we ended up negotiating with the funder that provided the second largest amount of funding. Sometimes you have to be creative. The only exception to recognition by all federal agencies is when an indirect cost rate is limited by the authorizing legislation for the program. Once the proposal is submitted, as I've mentioned, it can take months to hear back. Most agencies will try to accelerate approval for a first-time application. Often a nudge will help move the process along. Some agencies can turn an application around in weeks. I'm thinking of the Department of Interior, and some take years, and HUD comes to mind in that regard. So what happens? The question comes up. Your client received a federal grant, might be their first one, and the grant budget does allow for indirect costs. What are the options? And note that to be awarded a grant with a budget that does allow for indirect costs, you have to ask for those indirect costs. You can't assume that the agency is going to allow them. You have to be allowed to take at least de minimis, again, unless the authorizing legislation limits that. So you can elect to take de minimis as part of the budget and award approval negotiation process. But once you have that award, if you've gotten approval to do so, you can then also negotiate an indirect cost rate by submitting a proposal. Some additional thoughts on using de minimis. As I mentioned, it was never originally intended to cover true indirect costs. It was considered so low, especially that original 10%, that it would force most organizations to seek a negotiated rate. The newly approved higher de minimis rate is more likely to be close to many small organizations' true indirect rate, but to be sure, do the math and determine what your organization's true indirect cost rate is before you decide to accept the de minimis on any award. If you do decide to apply for a negotiated rate and the agency accepts that request, the organization must submit their initial indirect cost rate proposal within 90 days or 3 months after you receive the federal award. You have to be a federal award recipient before you're eligible to apply for a negotiated rate. And we'll talk later about how and where to submit such a proposal. So before we talk about the methods, we have to talk about direct costs. The direct cost base is a term you'll hear throughout any discussion of a NICRA. That is a total of the direct costs used to calculate the indirect cost rate. Direct cost base is the denominator when you do that division to get that ratio. Understanding that base is essential when you prepare a proposal budget and when you negotiate for a rate agreement. There are 3 allowable direct cost bases in the uniform guidance, allowed by uniform guidance. You can use direct salaries and wages. You can use direct salaries, wages, and add-on fringe benefits. And you can also use what's called modified total direct costs, or MTDC. If you're not sure what's included in fringe, that typically includes payroll taxes and employee benefits. It's up to the organization to decide whether to include the costs of paid leaves in the fringe benefits pool or not. Personal preference, I generally keep paid leaves in the salary lines because it makes it much easier to budget and track those costs. Note that the rate that is calculated must be applied to whichever allowable base you decide to use in your proposal. You can't switch to another direct cost base if you're operating under a negotiated rate. You can make a change in a subsequent year, but if you have a rate agreement for this current period, you've got to use the direct cost base that you applied for. In a bit, we'll look at some examples of rate calculations using these different direct cost bases. But first, let's clarify what we mean by modified total direct costs. What's included are direct salaries and wages and their related fringe benefits, materials, supplies, services, travel. And if you are making subawards to other organizations, you can include the first $50,000, which is up from 25, of each subaward over the full term of each award period. What's excluded is equipment, capital expenditures, and so forth, as well as the portion of each subaward in excess of $50,000, again, over the term of each award. Other items may be excluded where necessary to avoid a serious inequity in the distribution of indirect costs and with the approval of the cognizant agency. I've put an asterisk here by both equipment and rental costs because they're excluded in the definition, but many cognizant agencies do allow small equipment costs as well as rent and occupancy costs in the modified total direct cost base. So that would be a question for conversation as you start to get to know the cognizant agent. And just as a reminder, the cognizant agency is typically the agency that awards your client its largest dollar amount of federal funds directly. Here's an illustration to try to dispel a misperception that a higher indirect cost rate means a higher amount of indirect costs. That's just not true. In this illustration, you can see that our indirect costs remain the same across each example, but our direct costs are changing. Direct salaries and wages, of course, is a smaller number than direct salaries and wages plus fringe, which is also a smaller number than MTDC. So as you can see, as the direct cost base increases, our indirect cost rate decreases. While the MTDC rate structure usually yields a lower indirect cost rate thanks to that larger denominator, if the organization is a pass-through entity, this rate structure does require more management because you have to keep track of that first 50,000 of pass-through costs to each subrecipient. Not all funders want to pay for indirect costs. However, once a rate agreement is negotiated, it must be accepted by all federal funders as well as by pass-through entities such as the states that are making subawards to nonprofits. And while non-federal funders do not have to honor the federally negotiated rate agreement unless they're passing through federal dollars, changing allocation methods for different funders is a big red flag to federal funders. Therefore, it's very important to use a consistent allocation method across all your funding sources. So what generally makes a cost allowable? It's got to be necessary and reasonable to the federal award. For instance, buying a jet ski and charging it to a Head Start program is probably not going to pass muster. It's got to be treated consistently as direct or indirect costs. It's got to be applied using the same policies and procedures for federal and non-federal activity. It should follow GAAP, generally accepted accounting principles. You can't use a cost to meet cost sharing as well as a direct cost or indirect costs elsewhere. It's got to be adequately documented, keep your receipts, and it can only be incurred during the approved budget period for the award. So necessary and reasonable, apply your sound business practices. Think in terms of arm's length transactions. Consider market prices for comparable goods and services. No double dipping. I'm sure you've heard that back when PPP loans were prominent. That was a very prominent rule that was very commonly advertised. And while the definition says costs must follow GAAP, I'm still seeing an occasional single audit from groups that keep their books on a cash basis, which is non-GAAP. But in many of those cases, the funders are pushing them to move to accrual or full GAAP accounting. What costs are generally unallowable under federal award guidance? This is a partial list. The most commonly known unallowable cost is alcoholic beverages. Unallowable costs are costs incurred by a program that will not be covered or reimbursed by the federal government. Financing costs to acquire, construct, or replace capital assets are allowable, subject to certain conditions that are spelled out in the guidance as well as the award documents. These are generalized rules as outlined in the UG. This is not comprehensive. And if an agency decides to allow any of these costs to be attributed to their award to your organization, then they're allowable costs, but on that award only. So be sure you get that understanding in writing. I will say it now and I will say it again. Be sure to read your award documents carefully. They're going to be daunting, full of government legalese. They'll put you to sleep, but they also contain a lot of information about what the funder expects of you as an awardee. Where can I find these rules? 2 CFR 200, we talked about subpart E. It outlines general provisions and basic considerations, how to classify costs. It includes a basic description of the indirect cost rate negotiation. There are different considerations for states, local governments, and Native American tribes. And again, there are general provisions for selected items of cost. These rules are not listed neatly in the Code of Federal Regulations, so it's a good idea to become familiar with the entire subpart, but do allow yourself time to absorb these rules. I go back to them time and again to check as questions come up. I've got this in here as a sample budget summary. If you've ever developed a budget for a federal award application, you will recognize this format. It hasn't changed in the 25 years I've been working with federal awards. And note that there is almost always a line for indirect costs. If there are no indirect costs in the approved budget, they usually can't be added later. So it's worth asking the funder if you take on an award. It's worth asking if you can revise the budget after final approval, but I seldom see that happen. And then one more reminder, as you build out the detail behind these numbers, be sure you hang on to those support documents so that you can remember what you were thinking and do the analysis of why or why not things may be varying from your budget. So just to recap, we talked about an entity receiving a federal award. They can use, they have to speak up and ask, but you can elect to use de minimis, or you can negotiate an indirect cost rate. And if that's approved, the entity must submit that application within 3 months of the award. We also talked about the meaning of indirect costs, that there are good and bad reasons to apply for a NICRA. Proposal contains documentation that supports your claim for reimbursement. And in addition to uniform guidance, you should look to the federal award. The option to negotiate, as I think I've already mentioned, is limited to organizations that are prime recipients, receiving money directly from a federal agency. If the organization receives all the federal money as a subrecipient, most agencies will not negotiate, and that's outlined in the guidance itself. The subrecipient must then negotiate with the pass-through entity, but they're at least allowed to take de minimis. Note that each federal award made to an organization, the grantee will have a programmatic as well as a financial agency representative. Both are great sources for help understanding the award requirements and answering your questions. That's their job. It is not a red flag if you call them up and say, I'm not understanding what this paragraph means. So do whatever you can to establish good working relationships with both of these contacts at the agency, as they not only want to help, but they can advocate for your organization if necessary. And before we move forward, Claire, are there any questions?
Yes, there's a question in the chat from Gina. She says, can you negotiate an indirect cost rate if you don't currently have federal funding?
Typically, no. No, you have to have at least one federal award to apply and negotiate. Now, you can do the analysis to determine what your rate is. And I just went through the exercise, in fact, with Department of Energy, with a group that was applying for their first federal award. So, of course, they did not have a negotiated rate. But we did an analysis and showed them the rationale for what our true indirect cost rate was, which was higher than de minimis. And DOE accepted it in the budget. So it's always worth asking. These are generalized rules, but every agency, as I've said, will interpret the guidance differently. Now, I know time is of the essence. If you do have questions that I don't get to during the program, you can feel free to put them in the chat and I will follow up later. We're going to take a quick look at the different types of cost rates. You've probably all heard of a provisional rate. That's most often used for first-time applicants. It's typically paired with a final rate. So if you're awarded a provisional rate initially, a year, once you have your audited financials for the end of the period, you'll submit a proposal to finalize your rate based on that audited information. There are also fixed rates that apply when the nature of the work doesn't change significantly, and they're typically used for short-term projects. There is a carry forward feature on this rate type, which means that the difference between the approved rate and the actual rate carries into the following year, so that math can get a little fussy. A predetermined rate is used when historical financial data shows reasonable assurance that a reimbursement rate is likely to remain stable based on the entity's actual costs. I've seen this offered by states that pass federal money through to nonprofits as subrecipients, and that rate structure may work well for a state that's a bit of a monolith, but the states often don't understand what drives nonprofit rates to be more variable than a state's operations. And then, of course, there's de minimis, and we'll talk again at more length. This rate structure may be used whether your true costs are above or below this rate. Using the de minimis, here's an example. Whatever rate we're using, it all starts with a report called a Statement of Functional Expense. And that report shows up either in both audited financial statements as well as on your Form 990. But we've kind of compacted the Statement of Functional Expense here for want of space. We've segregated our total direct costs from total indirect costs, summed them up into the totals. Because de minimis is based on modified total direct costs, we have to adjust our total direct costs accordingly. So we go with the 7.264 million. We have to take out in-kind contributions because they're not allowed to be included, or in-kind expenses in this case. They're not allowable costs for purposes of a NICRA. Once we determine our modified total direct costs, then we multiply by the 15% to get the 603,000. So as you see, de minimis, it comes close to our indirect costs in this example, but this is a reason why using de minimis is sometimes a reason to consider negotiating if you're just not covering your true costs. If you get a lot of federal money, this can have a big impact on your funding. What else should I keep in mind if I'm choosing de minimis? An entity can use de minimis even if it's had a NICRA in the past, but once you elect it, you've got to use that rate for all federal awards until a negotiated rate is received. You can't use a NICRA on some awards and de minimis on others. You've got to be consistent. So you can apply for a negotiated rate only if that option was requested during the original budget negotiations. So be sure to ask. If you're spending out awards made prior to 10/1 of 24, it's fair to ask your funders if they'll consider allowing you to do a budget modification to take the higher de minimis rate. I've seen many say no, but today I just saw one say yes, so it's always worth asking. Here's some examples of what that rate agreement will look like. There's a lot of information in them. You need to read it carefully to make sure it's what you expected based on your proposal, as well as any follow-up conversations. You'll see, in addition to the indirect cost rate, the agreement will contain the effective period and a description of the direct cost base. So in this case, the organization has gotten a final rate for the 2022 calendar year and provisional rates for the next 2 years. Their base is total direct salaries and wages, including vacation, holiday, sick pay. And there's discussion of the treatment of fringe benefits as well as paid absences. Here's another one showing a fixed rate, a final rate, a fixed rate with carry forward provision. This base is total direct salaries. Again, it discusses fringe benefits and paid absences. It's relatively simple. Here's one for a university, Johns Hopkins. And you can see it's far more complex because there are a lot of elements to the Johns Hopkins University system. Some are doing research, and there are specific rules for universities that do research. Some departments are instructing, and there are other activities. In this case, they also have fringe benefit rates that apply to different aspects of the organization. Unless your funder requires that you seek a negotiated fringe benefit rate, I always advise against it, because with health insurance, as volatile as it can be, sometimes you can get caught short if you're locked in to a maximum on your fringe rate. We're heading into the home stretch. Are there any more questions, Claire?
I don't see any more questions, but everyone can please feel free to drop any questions in the chat or in the Q&A box if you have any.
Okay. So now we'll talk about preparing that proposal. This is a high-level discussion. We mentioned earlier that the math all starts with your statement of functional expenses. You need to be able to break out your direct costs from G&A and fundraising. It should include a column for adjustments. It makes it easier for the negotiator to see what you're thinking. And but as you do this too, the totals should all tie back to the statement of functional expenses in the audit. You need to be sure that your accounting system can keep track of funders, programs, project activities in order to do this effectively and convince the negotiators that your organization deserves a negotiated rate agreement. Having that rate agreement reassures the funders that they're not paying for more than their fair share of indirect costs or overhead. It also shows that you have the capacity to track and allocate costs fairly and accurately. Here's a list of typical, what goes into a typical proposal. But before you spend a lot of time figuring that out, check your cognizant agency's website to see if they provide a template or a recommended format for submitting the rate proposal. One thing I hear from negotiators time and again is that organizations will submit applications that don't follow the format that they prefer, and that can take a lot more time, a lot of back and forth. And then if you do see, some agencies are great about putting their staff contact information right up front. Save that down so it's easy to find when you need to reach out. So we talked about cost policy statement. We'll see a quick example of that. For the first time application, you usually have to submit an org chart. Most agencies want to see payroll reports, sometimes timekeeping, timesheets. They may ask for documentation of your fringe benefits. If you receive an audit, you have to send that in. If you're not getting audited, you can send a Form 990. They do require a schedule of awards. So if you're getting a single audit, if you're getting more than $750,000 or eventually $1 million in federal funding, you can use your schedule of expenditures of federal awards to meet that requirement. There's a year-over-year analysis required, and then, of course, the math to calculate your rate. A copy of the cost allocation policy for allocating and identifying direct and indirect costs. The schedule of awards, as I mentioned, can be met by the CFA, and of course, there may be other information requested, such as a copy of the compensation policy, severance policy, or bonus policy. Depending on how well documented, how clear your presentation is, the cognizant agent may come back asking for more information. So how long does it take to submit? There's no absolute limit of time to request an extension for the filing deadline. You've got to submit within 90 days of receipt of your first federal award if you want to be able to use that NICRA on that first federal award. And then it must be renewed every year and submitted within 6 months after the close of each fiscal year. Many of you may be seeing that audits are not getting done within within 6 months after year end. Other factors may delay renewal, so you can request an extension. It's not required. You won't be penalized if you don't do this. It's a courtesy to the cognizant agency so that they can plan their workloads. I've mentioned that annual renewals are required for the life of the federal awards. Once you submit the application, be prepared for a long wait. This is an example of a very summary cost policy statement where we simply take the natural line items from the statement of functional expense and describe how the organization attributes costs to those different types of expenses. Some agencies require a narrative version of this. This is a model that HHS accepts, but be sure to make sure to find out what your cognizant agent would like to see. Since we're now required to describe the organization's allocation method in the notes to the audited financials, you've already got the basics in hand. All we're doing is elaborating on that. The proposal package will include a cover letter, the proposal itself, a narrative that explains what we're asking for and why, that cost policy statement we just saw, the support schedules that show the math, how we came up with the numbers, and there are additional attachments that vary somewhat by agency. A checklist is sometimes required, the different certificates. If you're a very large organization, you may be doing a facilities and administrative negotiation, and then the copy of your most recent indirect cost rate agreement if this is a renewal. The proposal and any related certifications must be signed by someone at the organization at a level no lower than Vice President or Chief Financial Officer. We at YPTC and other consultants cannot sign that proposal, but we can be named as authorized contacts if there are questions along the way. Will subawards need to apply for NICRAs? A subawardee may choose to negotiate its own rate directly if you're receiving federal funding directly. Some agencies do require that once a rate is negotiated, it must be used in all agreements, either as a subrecipient or prime. Subrecipients without a negotiated rate may use the de minimis rate. If an organization does not meet the eligibility criteria to negotiate directly, they may also use the rate of the pass-through entity if both parties agree. And in that case, it is the responsibility of the pass-through entity or the prime in that relationship to work with the subrecipient to determine the appropriate rate if de minimis is not elected. So just if you're not familiar with the terminology, again, a subrecipient receives federal money passing through from another nonprofit that's receiving the award directly. Some common sources of discussion and disagreement during the negotiation process includes questions about whether a cost is allowable or not. They may question the cost allocation methods if they feel it's haphazard or not being applied consistently. And indirect costs must be allocated to all grants and contracts whether an award will cover them or not. Non-federal revenue sources must be used to pay for any unrecovered costs. So this is why it's important to provide clear communication and complete documentation from start to finish. Resolving disputes requires a thorough understanding of the regulations and clear documentation of cost justifications. When the actual indirect cost rate is higher than a provisional rate, sometimes a grant modification can be negotiated to transfer budgeted direct costs to the indirect cost category, or vice versa if you're running below. So that's why it's critical to monitor your true indirect cost rate each year and manage your reimbursement requests as closely to actual rate as possible so that there are no surprises at the end of the award or at year end. In general, the total amount awarded won't change, but your organization may be able to transfer amounts from one budget category to another, as mentioned. So while you're waiting, you submitted your proposal. While you're waiting, you can use what you learned to develop and maintain accurate records of indirect costs. You may have decided to change the way you're attributing some costs. You can analyze your current year's indirect costs. What's your actual rate now? Because you're usually negotiating based on an historical period, since it's already been audited. You can develop a plan to manage the organization's resources until you have the approved rate agreement. And you can get to know your federal program and finance officers on the awards if you haven't done so already. Once you do receive the rate agreement, read it over, make sure it's what you expected to see, and then sign and return it as quickly as possible. Revise any processes that you might want to change to make next year's data gathering much easier. You can revise your cost policy statement if it has changed in the current year, monitor your costs so there are no surprises, and then put a reminder on your finance calendar for the renewal date. Let your auditors know as well that you plan to renew the NICRA on time and plan ahead to be ready for the auditors so they can get their work completed as quickly as possible. So now we have a NICRA. What do we do with it? In your current awards, it's a tool, a management tool to monitor actual performance against project budget. For future awards, it makes it much easier to develop your proposal budgets. Indirect costs must be calculated using the cost base defined in an entity's NICRA. You may have heard me say that before. Here's an example of how to apply a NICRA. In this case, our base is salary and wages, highlighted in this pale yellow color. The rate in our agreement is 27.1% of salaries and wages. We do the math and multiply and get that 75,900 number, and that's what we use in our budget. So look at how much easier that is than trying to figure it all out as you go. Just to recap quickly, we looked at allocation methods in the beginning. We talked about some basic information about what makes a NICRA, what it is, what purpose it serves. We talked about the different types of rate structures, as well as how to get ready to submit a proposal. We've included some resources, a lot of information, and if there's any time left, I am happy to take any questions. I'm going to stop sharing and take any questions that may be remaining.
We have one question in the Q&A from Kelly. Is there an amount of federal funding received where you see it makes sense to apply for a NICRA?
Well, if you don't expect to receive more in future, there's no absolute. But if I'm applying for my first federal award and it's maybe for 25,000 or maybe even 100, it depends on how much in context of your overall budget. I probably wouldn't fool with it. I'd take the de minimis rate, but that's an analysis I would do. I would look at my entire program comprehensive budget for the organization and say, gosh, if I accept this award and take de minimis, how much am I going to lose? How much, will I be subsidizing a certain amount of money? But if your first award is for $500 million, I would negotiate. But if your first award is for $50,000, it may not be worth the effort, especially if you don't expect to go after more federal money.
One person asked if the slides will be shared, and yes, the slides will be included in the follow-up email, so just keep an eye out for that. And then we have a question from Kim. When is the 15% de minimis effective?
It took effect on October 1st of this year, but what I'm seeing is that most agencies are, if you've already got an award in place where you accepted the 10%, they're not letting you change it to 15% for the period after 10/1. That said, it's always worth asking. I saw something this morning from Department of Energy, in fact, that said they would allow them to take 10% on the first 3 months of their award up to 10/1 and 15% after 10/1. So they're doing a budget modification. It really depends on the agency, so you should ask. But any new awards that are made now, you should have access to that 15% de minimis. If you're getting pushback from the states are notorious for fighting these federal rules. OMB now is creating an office to enforce their own rules. So you want to report that back to OMB. But that can be a challenge for many organizations working with the states.
Got a question from Gina. This is a question about de minimis indirect rates. Our organization has a federal award that follows the state fiscal year, June 2024 to July 2025, which includes the old de minimis indirect rate, 10%, and another federal award that follows the calendar year, 2025, where we can elect to use the increased 15% de minimis indirect rate. Since the awards periods will overlap by 6 months, how should we handle that? Will it be an issue if we use the 10% indirect rate on one award and 15% on the other if they overlap?
Well, I did say consistency is the name of the game. This is a unique circumstance where you're juggling those two different rates. So you'll only be able to cover 10% on those awards that only allow the 10%, but you'll need to if they're crossing over, you would need to do a budget modification. But if they're not, you're going to have to lay out your work papers in such a way so that you can illustrate, we only ask for 10% here, but we're taking 15% here. I'm not saying it's easy, but you're certainly not going to get penalized during this interim period when you've got those rates changing, crossing that effective date.
Those are all the questions that we've received so far.
Okay, well, thanks for sticking with me. I know I ran a little bit long. I really appreciate your attention to this topic. If you do have questions, please feel free to reach out to me and I'll be happy to respond to your emails or set up a call.
Great, and thank you, Hatsy, for sharing this information with us today. And thanks to everyone who attended. We really appreciate it, and we wish that you all have a great day.
All right, thank you.